So, welcome students, welcome to lecture number 1, okay, where we will be seeing module number 1 under subject financial management. So, financial management, this particular subject, the entire syllabus is divided into 6 modules. So, you'll be having 6 modules under this particular subject. That is, first module is Introduction to FM. Introduction to Financial Management, where you will be given a basic introduction as to what is financial management, what are its objective, the basic aspects of financial management will be covered under module number 1. In module number 2, you have time value of money, where you will be learning that how the value of money keeps changing with time. So the value of money today will not be the same tomorrow. So how the value of money keeps changing over a period of time, that you will be studying in module number 2. Module number 3, you will be studying sources of financing and cost of capital. Now, what is the meaning of sources of financing? See, if an organization, if a company requires finance, it has to approach to various sources. So what are the different kind of options available to the company to raise the finance, like through equity shares, preference shares, debentures, bank loans, and what is the cost associated in raising those finance or in getting those finance? So that we will be covering in module number 3. Module number 4, we will be seeing investment decisions. Under investment decisions, we will be seeing that once the finance is procured, how are to be utilized it? That means that once you have received the finance, in which projects are you going to apply this finance or utilize this finance so that you get optimum results, so you get maximum results and you get maximum returns. So making that investment decisions, how to make those investment decisions, we will be studying under module number 4. Under module number 5, we will be seeing working capital management. Now, working capital is nothing but the capital required for day-to-day working of the organization. So, how much the working capital is required by the organization, that particular calculation will be seeing under module number 5. Under module number 6, we will be seeing capital structure and dividend decisions. Now, what do you mean by this? As I told you that in module number 3, we will be seeing the different sources of finance. And in module number 6, we will be seeing that which will be those different sources of finance which will form a capital structure in such a way that it is going to give us the maximum returns. And the how to analyze this capital structure will be studied in module number 6 along with dividend decisions. Now, dividend is nothing but the payout to the shareholders, or the returns to the shareholders is nothing but the dividend that is given by the company to its shareholders. So what should be the dividend given? What should be the percentage? How frequently it is to be given to the shareholders? All these decisions we will be studying under module number 6. So I have just given you a gist of what all we will be covering in the different modules under subject financial management. So let us today begin the lecture with module number 1. In module number 1, as we know, it is Introduction to Financial Management. So let us understand what all is to be covered under this particular module as per your VTU syllabus. So as per VTU syllabus, it covers what is the meaning and objective of financial management, what are the changing roles of financial managers, interface of financial management with other functional areas, the Indian financial systems, financial markets, financial instruments, financial institutions and financial services, emerging issues in financial management, risk management, behavioral finance, financial engineering, and derivatives. Students, let me tell you that module number 1 is a complete theory module. You do not have any problems in this particular module since it is just an introduction, just a basic towards financial management. So the entire module is completely theory. So today, in today's session, let us see what we will be covering. So today we will be covering what is the meaning and objective of financial management, the changing role of financial managers, and interface of financial management with other functional areas. Students, since this particular module is a complete theory module, okay, just pay attention to the explanation I give, and as and when whatever questions are asked in your exam, you need not write the same thing what I'm giving you in notes or what you all are seeing in other textbook. You can write it in your own words, provided you all are writing it in respect of the question that is being asked. Okay. So let us start. I think there's one student who's waiting. So just give me 2 minutes. I'll just let her in. Okay, so we have already seen that today what all things we will be covering. Now let us move ahead. Let us understand what is the meaning of financial management. Students, simply let me tell you what is the meaning of financial management. Managing the finance. Managing the finance of a company, of an organization means financial management. Totally taking it from the procuring the finance. See, every company or every organization will not be having sufficient finance with it. It has to fund its finance. It has to raise its finance. Okay, so taking from the step from raising the finance, okay, and utilizing that particular finance, managing the entire process between procuring of funds and utilization of funds, managing that particular line between procurement of funds and utilization of funds is nothing but financial management. So simple language, financial management means managing the finance of the organization or of the company. Now let us see what is exactly all financial management consists of. Financial management means planning, organizing, directing, and controlling the financial activities such as procurement and utilization of funds of the enterprise. Now, when it means it starts with planning, what you have to plan? You have to plan that what all are the resources from which you can get the finance. So you have to plan whether you want to get the finance by taking a bank loan, or whether you want to get your finance by issuing the shares, you want to get your finance by issuing the debentures. So first thing is you have to plan. You have to plan the means and ways to receive the finance. So always financial management begins with planning. See, everything goes well if it is planned, correct? So even the finance of the company, first step that is taken by the financial manager is he does the process of planning, where he plans that what is the amount of finance required, number one. Number two, okay, what should be the sources from which he can raise the finance. Next is organizing. So once he has raised the finance, once he has planned and he knows that he is going to he's required X amount of finance to run the company or to run the projects in the company. Second thing is he has to organize. Organizing means what amount of finance has to put in each project in the company. Like suppose if they are planning for X amount of finance, then which are the different areas in which that particular finance has to be utilized. The entire money, the entire finance cannot be put only in one project in the company. So organizing means dividing that finance in different areas which requires the utilization of funds. Next is directing. Directing means the financial manager has to direct the areas which requires the finance and the amount of finance required in each particular area. And controlling the financial activities, it is very important. Controlling the financial activities is a very important part, because once planning is done, once organizing is done, directing is done. If the control is not there, there can be misutilization of funds, there can be theft, there can be lots of fraud happening in respect of the finance that has been procured. So controlling those financial activities is very important. So financial management has two aspects, students. One is procurement of funds and utilization of funds of the enterprise. So in simple language, financial management is a managerial activity which is concerned with planning, organizing, controlling all the firm's financial resources. Okay, so this is the meaning of financial management, and with only one intention is to achieve the overall goal of the business enterprise. Whatever is the goal of the company, of the business enterprise, of the organization, to achieve that, okay, all the resources, financial resources, have to be properly managed. So students, have everyone understood what is the meaning of financial management? Yes,
Yes, ma'am.
students?
Yes, ma'am.
Okay,
Yes,
so
ma'am.
let us, very
Yes,
good.
ma'am.
Good. So let us move ahead. Let us understand what are the objectives of financial management. Why is financial management required in a company? What are the objectives? Why should one plan the finance, or why should one manage the finance? Students, this is a very, very important question in respect of your final examination, because this question is frequently asked in your examination. What are the objectives of financial management? So basically, the primary objectives are only two, students. One is your profit maximization and one is your wealth maximization. Now let us understand what is profit maximization. This implies that the finance managers has to make his decision in manner so that the profits of the concern are maximized. Students, first primary objective is profit maximization. Students, even if you all set up a business, okay, so what will be your first objective? Your first objective is, if I'm investing money in the business, if I'm putting the capital into the business, my objective is to earn maximum profit. Correct? So one objective of financial management is profit maximization, in which the financial manager is only having one thought in his mind, that how should I, or how should the company earn maximum profits out of the resources that have been invested in the company, out of the resources, financial resources that have been applied into the company. So the profit maximization means that where the financial manager just thinks of maximizing the profit of the company. So what happens in this? What exactly happens in this is, the financial manager will always make his decision in any field of finance only with one objective or one thought in his mind, that with this investment my profit should be maximized. He's not worried about all other factors. He's not worried about what is going to be my market. He's not worried about what is going to be my market goodwill. He's not worried about the employee struggle. He's not worried about the quality. He is not worried about other factors. He's just worried about one thing, one thought in his mind, that how will I maximize my profit with a particular investment decision. But this objective of profit maximization has few drawbacks. So the drawbacks are, first drawback is, profit maximization itself is too vague. Now what is the meaning of too vague? Too vague, it means different to different people. Okay, for example, a profit may be short term, it may be long term. Profit may be total profit or rate of profit. In the sense, let me explain this. The word profit is not clearly defined. In the sense, financial managers can think of making a short-term profit. Correct? So his objective is limited to a short-term profit, whereas profit can be for a long-term period also. Profit can be calculated on the total income. Profit can be calculated on the rate percentage also. So the word profit is exactly not clear, since it is too very vague, and for different financial managers they may have different objective regarding the profit. Some financial managers may think of just making a short term profit. Some financial managers may think for going for long term profit. So the term is too very weak. Risk. Profit maximization has to be attempted with the realization of risk involved, because there is a direct relationship between risk and profit, students. Many risky propositions yield high profit. So what happens is, since in this objective the financial manager has only one thing in mind: I have to make sure the organization or the business enterprise earns maximum profits. And when maximum profits are involved, where it is involved more, where the projects are riskier, so he will go on investing in riskier projects. Okay, but it is not always necessary that risky projects will always give you maximum profit. So what happens, since his thought is very limited to only profit, if the profit maximization is the only goal, the risk factor altogether will be ignored, because the financial manager will not pay attention on the risk. Irrespective the risk is high, he will just go on investing in those projects. So since the risk factor will be ignored if the financial manager has profit maximization as his objective, so this is one more drawback of profit maximization. Next is, profit maximization as an objective does not take into account the time pattern of returns. TPR is time pattern of returns. Suppose, for example, proposal A may give a higher amount of profit as compared to proposal B. Yet, if the returns of proposal A begin to flow after, suppose, 10 years later, proposal B may be preferred, which may be lower overall, but the returns flow is more quick and easier. So what happens in ignoring the time pattern of return here? There are two projects, project A and project B. I'll just give you one more example. Suppose project A is giving you high returns, high profit, but it is going to give you after 10 years. Now project B is going to give you low profit, but it is going to give you immediately. So which is more beneficial? Actually, project B is more beneficial because it is going to give you inflows from this year itself. But since the financial manager's objective is profit maximization, high profit maximization, therefore he will opt for proposal B, ignoring the time pattern of return as on today. Next, too narrow. Profit maximization as an objective is too very narrow, students, because it fails to take into account the social considerations. Okay, like I already told you all, like it fails to consider other aspects, like what is the interest of the workers and the consumers, what the consumers want, the society, the ethical trade practices. Just to earn profit, some companies, they may even follow unethical trade practices. So various factors have been ignored by the company, and such companies cannot survive for long in the market, students. So profit maximization is very short-sighted policy, because they ignore all the other factors just because they have an aim to earn profit. So these are some drawbacks of profit maximization. Since there are drawbacks in profit maximization, there is one more primary objective of financial management, which is nothing but wealth maximization. So the two primary objectives of financial management is profit maximization, and since profit maximization is having lots of drawbacks, there is one more objective of financial management, which is wealth maximization. Okay, so what is wealth maximization? So here the financial manager will aim at increasing the goodwill of the company in the market. So that is nothing but increasing the value, market value of the company in the market. So wealth, profit is internal factor, wealth is external factor. So this model holds that the primary goal of the firm is to maximize its market value, and implies that the business decisions should seek to increase the net present value of the economic profits of the firm. So here basically shareholders wealth, okay, is the company tries to, or is having a thought to maximize the shareholders value in the market, to gain the market value, to gain the goodwill in the market. So here So here the main objective of the company is to increase the wealth not only internally but also externally in the market, which has been ignored in profit maximization. So what happens here? Here the shareholders' wealth are the result of the cost benefit analysis that they get in respect of the time and risk. So your risk factors is considered, your time pattern of returns is considered, your the overall business decision is based on how the market value is increased. Suppose a market value of a particular company is high in the market, what happens? Many shareholders will want to invest in the market, correct, will want to invest in the company, and what will happen? The economic profit of the company will automatically increase. So wealth maximization is much more uh, bigger, larger, and broader objective of financial management. So students, is the primary objective of financial management clear? And here the value of the firm in wealth maximization is like depends on the number of shares into the market price of these shares. Because the number of shares, since the value of in the market will increase, the number of shareholders will increase, and when the number of shareholders will increase, the market price of the shares will also increase, which will create wealth for the company in the market, not only for the short run but also for a longer period of time. So students, is the primary objective of financial management clear? There are two objectives: profit maximization and wealth maximization. Yes students, is it clear?
Yes, ma'am.
Yes, ma'am.
Okay.
Yes, ma'am.
Okay, so let us now see the highlights of the primary objectives that we have covered. So the goal, financial manager has either two goals, two primary goals: profit maximization and wealth maximization. So what is the objective in case of profit maximization? Making large amount of profit. Okay, and what is the objective in case of wealth maximization? Gaining the highest market value of shares. Now, each particular objective has its own advantages and disadvantages. So let us see the advantages in case of profit maximization. It is easy to calculate profits in case of profit maximization, students. Easy to determine the link between financial decisions and profits, because once you have invested in a particular investment or in a particular project, it is very easy to determine that what was the amount invested and what is the returns the company is receiving in respect of that particular investment in the project. Next, next, let us see what are the disadvantages of profit maximization. Like we have already seen earlier, emphasis the short-term gains. That is, the term profit is very vague, ignores risk and uncertainty, ignores the time pattern of returns, and requires immediate resources. Now, let us see what are the advantages of wealth maximization. Emphasis the long-term gain. This is not short-term. Well, when the goodwill of the company, the motive of the financial manager is to make the goodwill of the company. In that case, it is always the company which is ethical, which is working on the market value. Always it is going to have a long-term gain. So emphasis is on the long-term gain, recognizes risk and uncertainty, recognizes the timing of returns, and considers shareholders returns. So it is totally opposite to profit maximization. Next, what are the disadvantages of wealth maximization is offers no clear relationship between financial decisions and share price, can lead to management anxiety and frustration. Many a times what happens, students, even when a company is having wealth maximization as its objective and it makes various investment decisions, and sometimes if those investment decisions fails, that can create a lot of management issues, lots of anxiety, frustration, irritation in the management, because the profit also is not achieved, likewise the wealth also is not achieved. So this is a major disadvantage of wealth maximization, because all the investments are not necessarily can make wealth. So if there is some particular loophole, or if there is some particular defect, the entire decision can fall, and it can create to management anxiety and frustration. So students, highlights of objective. Is this particular clear? Is this particular slide clear to everyone? Yes, students?
Yes, ma'am.
Okay. If there's
Yes, ma'am.
someone who is waiting, okay. There's just someone who is waiting in the room. Let me just admit it. Okay. Okay, so moving ahead, there are again secondary objectives of financial management, that is proper estimation of total financial requirement. Like the next objective is making an estimation of the total finance that is required, proper mobilization of funds, that making sure that the funds are properly utilized in the areas where it has to be utilized, proper utilization of funds, proper coordination, maintaining proper cash flow, survival of the company, creating reserves, creating goodwill, increasing efficiency, reducing the cost of capital, reducing the operating risk, and building an appropriate capital structure. So all these are secondary objectives, students. The most important is the primary objectives of financial management, which is only profit maximization and wealth maximization. Apart from that, a financial manager can also have all these objectives in his mind. Okay, so is any explanation on any particular objective required, students? As I've already covered this while explaining the primary objective. Does anyone require any explanation on any particular points mentioned here? Yes, students? Students?
Yes, ma'am.
Okay.
Ma'am, proper mobilization, please explain.
Okay, students, once the finance is procured, okay, so there are different areas where you have to put your funds. So you have to make sure that the funds are properly mobilized in those particular areas where it is required. Suppose you have, for example, you have some amount in your wallet, okay, it is just kept in the wallet. You have to make sure that you properly mobilize that particular amount in the different expenses or different investments in which you have to put or utilize those finance. Correct? If it is in your wallet, that doesn't mean that it will automatically go to that particular area where you want to invest. So you have to mobilize, make sure that the finance flows from your wallet to that particular area where the investment of funds is required. So similarly, in case of company, once the funds is once you determine what is the amount of funds required, you have to properly mobilize it. Mobilize it means move that fund from your wallet, from your bank to that particular area where the investment is required. So there has to be a proper movement of funds so that there is no misutilization of funds. Is it clear, student?
Yes, ma'am.
Ma'am, increasing efficiency.
What, student?
Increasing efficiency.
Okay. Increasing efficiency means you will invest in those particular areas where your profit or your returns in those particular areas has to be increased. So increasing efficiency in the sense means the objective will be not only to invest in those areas which is not giving you returns, but in investing in those areas considering risk where the returns are there, plus where the workers are working in such a way that it is going to increase the overall efficiency. So here the workers efficiency, here the investment, you have to make a determination of whether it is going to, that particular project is going to be efficient enough for you to earn that particular amount of returns while managing the risk factor.
Okay, ma'am. Reducing operating risk.
Reducing operating risk. Now, what do you mean by operating risk? Operating risk means the day-to-day operations, what is run by the organization, company, or business enterprise. There are various risks associated with it. So your financial decision or your financial funding should be in such a way which should not impact the operating operations working or running in your organization. So the objective of financial managers should be in such a way that whatever risk is associated with the day-to-day operations, your decisions, financial decisions should not hamper the operations, thereby reducing the operating risk associated with the operations.
Okay, ma'am.
Yes, students? Is it clear?
Yes, ma'am.
Okay, let us move ahead. Changing role of financial managers. So let us understand this particular thing. Students, earlier in the traditional corporate finance, what we used to see, the work of the financial manager was just to arrange for finance and manage it. His role was only just to arrange the finance, manage it, like how to utilize it. That is that the work of the financial managers was limited to only that particular aspect in case of the traditional corporate finance. But now there is a modern financial management which is a way ahead than this traditional finance. Okay, so now what happens here is the opportunities available to the financial managers are not limited. They have no limits. So the financial manager now, apart from only thinking of procuring the funds and utilizing it, he is into the role of different various other categories, different various other aspects is what the financial manager has to look into. So first thing is the changing role of financial managers means from the traditional financial finance to the modern financial management, what is the role that is changed of the financial manager? So apart from just procuring the funds and utilizing it, what are the different areas he is looking into in the modern financial management? So let us understand that. Financial analysis and planning. As I already told you that today a financial finance executive of an organization is playing a very important role because based on his role depends the company's goals, policies, financial success. So all these things are dependent on how the financial manager works. So the first changing role of financial manager is financial analysis and planning. So what is the meaning of this? This means that he is determining the proper amount of funds that is required in the company, that has to be employed in the company, in the firm, okay, and designating it in such a way that the size of the firm and the rate of the growth increases. So financial Students, am I audible?
Yes, ma'am.
Yes,
Yes,
ma'am.
ma'am.
So sorry, students. Actually, the laptop battery was too very low, and I didn't realize the switch was off. So sorry for this particular disturbance. Okay. So we can everyone see the screen? Yes, students.
No, ma'am.
No, ma'am.
No, ma'am.
Okay. Now can everyone see the screen?
Yes, ma'am.
Yes, ma'am.
Okay. So sorry, students. Okay. So financial analysis and planning, we were dealing with this particular changing role of financial manager, where the manager has to not only determine the amount of the funds that is required, that is to be employed in the organization, but also it has to plan that how these funds have to be properly utilized so that it increases the size of the firm, so that it increases the rate of growth for the firm. Apart from this, the second changing role of financial managers is risk management. Now, what is the meaning of risk management? Risk management is protecting the assets of the firm. Once a financial manager has taken a decision of investing a particular amount in a particular asset, it is also taking a role, a new role in the modern financial management to protect those assets as well. Because if it fails to protect the assets, what will happen? It will lead to extra cost to the company. This was not in the traditional financial management. That the role of traditional financial manager was just to procure the funds and utilize the funds. He was not bothered about the risk management aspect. But now in the traditional financial, in the modern financial management, financial managers are not only investing the funds in a particular assets, but also they are making sure that they are protecting that assets. Now, what do you mean by this? I'll just give you an example. Suppose a financial manager takes a decision of investing some funds in building a particular building a particular area for his business. So he builds a building for to run a particular business. Okay. Next, he's invested the funds in making the building. Correct. Second thing he'll also do is protect that building. How will he protect that building? By making an insurance for that building. Suppose tomorrow if the fire catches up, the entire building gets burned, and if the financial manager has not made sure of protecting that asset, what will happen? It will lead to extra cost. Okay. But now in this modern financial management, the financial manager will invest in the building, will make sure that he protects that building. Okay. Therefore, he is also playing a role of a risk manager. So this is the second changing role of financial manager. So is this clear, students? Next, investment decisions. So investment decisions is where the financial manager will invest in only those particular projects, okay, where he's going to get, where he's going to efficiently utilize the funds only in those particular projects where he's going to get the maximum returns. And the maximum returns he wants to fetch in such a way where he's going to make efficient utilization of resources, which means that wastage of resources will not be appreciated, where he will, his mind, he will keep only one thing in his mind, that he has to make maximum profits by utilizing the resources effectively. Next, capital structure decisions. So here favorable terms, that is determine the composition of liability. See, there is two things, that is debt equity. You know that a company can raise its capital through debt, to depend, that is the debentures, through equity, through bank loan. So it will raise the funds, the financial manager will raise the funds in such a way where all the funding will be the sources through which it is going to raise will be favorable to the company or the organization. So the composition of the capital structure of the company, capital usually comes on your liability side. So the composition of the liability will be in such a way that it will be favorable to the company, keeping in mind the cost related to raise that particular finance. Next is management of financial resources, such as working capital, which I've already explained earlier, that apart from just procuring the funds and utilizing it, it also has one changing role, that is it is going to manage the financial resources in the organization, such as working capital, because working capital is required for the day-to-day working of the organization. And if the financial resources are properly managed, then that will lead to a smooth flow of the operations of the company. So students, is the changing role of financial manager clear? Yes, students?
Yes,
Yes,
ma'am.
ma'am.
Okay, so let us move ahead. Interface of financial management with other functional areas. Now, see, every company, every organization has different departments in itself. So it has a finance department, it has marketing department, it has HR department. So here in this particular aspect, we will be seeing that how financial management will interact with other areas or other departments of the company. So financial management, this has a link, has interface with accounting. Now, how does it has interface with accounting? See, the relationship between the financial management and accounting is very closely related, because accounting is an important input in the financial decision. Based on your accounting, the financial manager will take a decision, will make a financial decision. So in other words, let me tell you students, accounting is very necessary input for the financial management functions, because only once if accounting is done, the financial manager will understand the position of the company, and based on the position of the company, the financial manager will be able to make correct financial decisions. Next, production. How is financial management related to the area of production? See, once the amount or once the funds are there, then only the company will be able to procure the raw materials, purchase the machinery, do the processing, take care of the stock, and take care of the work in progress. Because financial management is the base through which different areas or different departments of the organization work. So let me tell you students, if a company has to start any business, okay, it requires funds. With the funds only it can procure raw materials, with the funds only it can purchase machinery, with the funds only it can employ the employees who will do the further processing, with the funds only the company can take care of the stock and work in progress. So the financial management is very closely related to production, because finance is the base for the organization. Only if the company has finance, then only the other areas or other departments in the organization will work. Next, marketing. Finance is also required in respect of sales, promotion, and distribution. Now, if any company wants to make its sales or promote its products or distribute its products, finance is required. Very simply, let me just give you an example. In respect of sales, when a company wants to sell its products, it has to hire a sales manager, correct? It has to open outlets where it can sell its products. So for that particular thing, finance is required. In case of promotion, for promotion it requires advertising. Okay, it requires banners, it requires lots of it requires social media, digital marketing, for which the base is finance. For distribution, it requires finance again, because distribution involves traveling cost, which can again be possible only with the help of finance. Next, personally. Here, financial management is very important again, because personally is nothing but related to the employee of the organization. So the employee of the organization has to be recruited. To run any company, you require workers, students, you require labor, you require workers who are nothing but the employees of the company. So when you want to hire any employee into your company, you have to do a recruitment process. This recruitment process is not done free of cost. It involves lots of funds, which is again dependent on finance. Likewise, employee training. So what happens whenever an employee joins into an organization, the techniques, there are lots of innovations happening. So the employee has to be ready to adapt himself to those techniques, to those innovations. So there is a training process done. So when employee training process is done, again, it is not done free of cost. It requires finance. So finance is the base for even personally. Next, research and development, that is finding out new technologies, innovative products. Students, without finance, there can be no research and development happening in any organization, because huge amount of finance is required in respect of research and development, which is nothing but when an organization plans to innovated products, when an organization plans to bring new technologies, it requires an R&D team, and that team works on lots of experiments for which finance is required. So in this interface of financial management with other functional areas, it basically means how finance is a strong base, and with this base only the other areas or other departments of an organization can work. So only if you have a finance, you can have accounting done, you can have production done, you can have marketing done, you will have personally in your organization, and R&D done. So finance has interface with each and every department in the organization. Students, name one organization which works without finance. There is no organization or the departments in an organization that works without finance. For each and every work in an organization, finance is required, taking from the production to the marketing to the sales to the accounting to R&D. Everywhere finance is required. So finance has interface with all the functional areas in an organization. So students, is this slide clear? Yes,
Yes, ma'am.
students?
Yes, ma'am.
Yes,
Okay.
ma'am.
So thank you so much, students. We have completed the lecture for today.